All right, Greg, we're here today. You're one of the first traders that we're doing a call like this with. Hopefully we do more of these, but you have a new program on our site. So I thought it would be a good opportunity for people to learn a little bit more about you and your background and your program and see if it might be a fit for their investment portfolios.
Great.
So just to kind of get started, the program that is on our site is Divergence Trading Quantitative Capture Strategy, and I think what's most interesting about you is just kind of your background. You've traded some other programs in the past, have done so successfully, and now you're coming out with a new program. So if you can tell me a little bit about your background and the other programs you've traded and kind of what brought you to this point, I think that'd be a good way to start.
Sure. Well, I way back, I graduated from Yale in 1984, and I didn't know what I wanted to do, although I always, even back then, had a passion for trading. And then after I graduated from college, I spent 2 years at Bain & Company in Boston, which is a management consulting firm. Then I decided to get my MBA at the Amos Tuck School, which is Dartmouth's business school. Still wasn't quite sure what I wanted to do. Most of my friends went to Wall Street to go into investment banking or management consulting. And I decided after I got my MBA, because I had this passion for trading, to use that as an insurance policy almost, and head straight to the floors in Chicago to trade. So that's when I started trading. I traded on the floor at the CBOT for a few years, decided that I was a little more analytical than most of the locals on the floor. And I still wanted to day trade, but I wanted to trade from off the floor using charts and technical indicators. So I started in 1993, I started a CTA program, registered with the NFA. And it was called S&P Discretionary Trading Program. I day traded the S&P, and I did that for 23 years straight, all the way up through 2016. I had another program that was a systematic swing trading program mixed in there for a year or two, but I found that it was a distraction to my S&P program. So that's really the only thing I'd done for 23 years. And I was successful. I didn't have any losing years net of exchange fees and commissions during that time period. But I was also, it was found that especially after 2010, let's say, it became a little bit more difficult for me as high frequency trading firms developed algorithms that I think were specifically designed to make it more difficult for my style of trading. They had the speed that I didn't really have. And I was trying to trade size, and I think I stood out with my large orders. They were designed to make it a little more difficult for me. So the competition got more difficult. And on top of that, it wasn't really scalable. You know, as a day trader trading one market, you're limited in terms of how big you can become. So right around 2010, I started to think, well, let's try to develop something that was longer term, more systematic, traded more markets, held, overnight positions. And I'd go back and forth, and I'd try to code something, back test something, and I was never really comfortable with any of that. But it was always something I was constantly doing in the background. And then in 2016, when I stopped trading the discretionary program, I had a stint over the next 4 years with Haymeyer LLC, Chris Haymeyer's company, and Gelber Group. And I was fortunate enough to work with some great people over there at both of those firms over the next 4 years. But always in the back of my mind, I wanted to develop something on my own, a program on my own that was longer term and scalable, and traded a diverse group of futures contracts. I finally found that, and in 2021, and it was, in hindsight, it was unbelievably simple, and I can't believe I didn't discover something like this sooner. But I just wrote down on a piece of paper the three basic principles that I believe in, which are trade with the trend, and everybody knows these. All traders know these. Trade with the trend, cut your losses fast, and let your profits run. And then I developed some rules around those three principles, and developed the rules to the point where every situation was covered. Then I had somebody code the program for me, and I was able to back test 20 years of data on, and I used 19 diverse futures contracts in different sectors, and the results were unbelievable. I thought, basically, in general, I built in a 0 and 30 fee structure and a tick of slippage on every trade. Basically, what I found was that I risked a 0.5% max loss per trade on every single trade. What I found over 12,500 trades was that the annualized return was about 20%, and the worst peak to valley drawdown was also about 20%. But then people told me, well, I've never seen a bad back test. You got to do it in real time. That's great, but prove it to me. So I obviously agree with that, because I made back tests in the past and then tried to trade real time.
We see a lot of great back tests here.
Exactly. So in 2022, in July of 2022, I started trading it with real money, and I've been doing that ever since. I like the performance. A little bit lower risk than the back test, and that was intentional. And even though this is systematic and the execution could have been coded, I intentionally wanted to watch it every day so that I could learn. And I learned a lot over the past, year or two, watching its performance. But I scaled down the risk intentionally. And in November of just last year, 2023, I re-registered again with the NFA. After having been registered from 1993 all the way to 2016 as both a CTA and a CPO, I re-registered as a CTA in 1993, and now I'm looking to raise capital raise assets under management for this new program.
When you were at Haymeyer, were you doing proprietary trading or system development for other people?
I did a little bit of both. And then at one point, I was registered as an associated person, as a CTA under their umbrella. And so I moved around a little bit, and I would help other traders occasionally, but ultimately what they ended up most interested in me doing was focusing on the S&P again. So I did that primarily for I think it was 3 years that I worked with Haymeyer. And then they would raise the capital. They would bring in the investors for me, since I was an associated person.
So you've been trading consistently since 1993.
Yes.
With other people's money.
Yes.
And what were your peak assets like? What were kind of their normal assets like, normal round turns per year when you were doing it with the intraday program?
Well, with the intraday program, it was probably 100 million were the peak assets, which was a lot for me to handle as a day trader. It's notional. I mean, essentially the margins were not very high because I was completely out of positions overnight.
Sure.
But my peak assets were about 100 million.
Okay. So you've run a large firm before with pretty significant customer assets, particularly in intraday.
Yeah, and the
intraday strategy.
Yeah, and the round turns. I mean, I don't even want to guess. The round turns per year, per million, were much higher than they are with this program. I don't even want to guess how high they were. But as a result of my high volume, I had very, very low commission rates.
Sure. Actually, according to our site, and if people want to look, the previous program is called Granite Star Capital discretionary strategy for 14,000 round turns per year per million.
14,000,
which is pretty significant, and particularly the fact that you made money net of fees going back that far. Commission rates were very different in the early and mid 90s than they are now. So yeah, even with that volume, rates, your returns would have been significantly higher in today's environment.
That's right.
So that brings us to your new program. So right now you're running lower risk than your back test. Are you purposely running it lower risk? Are you taking programs out? Or are you just reducing position size? How are you managing the lower risk?
Like I said, I have a max loss of 0.5% per trade. So I might make that max loss 0.25% per trade on some of these trades, never going over 0.5%. And that's primarily why the risk is lower. I'm not doing anything different to the rules, trading different than the rules suggest, but it's just primarily lowering the position size.
And you and I discussed the average margin to equity is also relatively low with this program. Can you talk a little bit about kind of peak margin as well as kind of average daily margin?
Yeah, the peak margin is going to be, in my opinion, never get higher than 20%. I'm a fairly conservative trader, and risk management always comes first on my list of priorities. The average margin is probably no more than 5% right now. It's mostly because of the reduced max loss per trade, but that's primarily. I think that'll primarily maybe go up to 10% on average, but probably never get higher than 10%, the average margin.
Okay. And can you kind of describe a little bit, we talked about the principles of the program. Can you talk a little bit about what markets it's trading, how you chose those markets, and kind of whether the same system applies to all the markets, things like that?
Yeah, I initially chose markets at the Chicago Mercantile Exchange. That's the exchange I'm most familiar with. I know there are other exchanges that have plenty of liquid futures contracts, but I wanted to stick with those that I knew. In terms of the sectors, I chose stock index, interest rate, foreign currency, soybeans and wheat, and precious metals, and both Bitcoin and Ethereum as well. The track record on those is on the back test, obviously, is not as long, but it was very impressive, and I think those are and I think they're liquid enough to include. And then I also, in terms of like what it might work on in terms of other markets, I've done some testing on other markets, particularly with markets like coffee and sugar and cocoa and orange juice, which all have had very sharp moves lately. It's worked great on those markets, and I'm considering adding those as well as a few other markets over time, one at a time. And that would allow me to also decrease my max loss per trade as I add more markets and diversify the performance a little bit more. But it does work on other futures markets as well as the ones that I chose initially.
Does adding those markets introduce capacity constraints? Are you able to get in and out of those markets? Kind of at what point would capacity start becoming an issue to trade orange juice in some of those markets?
Well, I don't think that capacity will come into play until I hit $200 million under management. And I have never traded orange juice. If I find that there's too much slippage in something like orange juice, I wouldn't trade it. And I'll know, I have enough experience to know if a market is or is not liquid enough for me to trade. So I can't really answer that question now without adding it and seeing how scalable it is. But if it's not liquid enough, I won't trade it.
Well, and it looks like your current holding period, obviously you were intraday before. What will the current holding period look like with the new program?
Well, the current holding period for losing trades could be 1 or 2 days, because this exits very quickly. The winning trades, I use a trailing stop on the winning trades, and it trails 1, 2, or maybe even 3 times per week. But the really successful winning trades could last 8 weeks. But the average winning trade, I would say, might last somewhere closer to a week and a half or 2 weeks. And that's by design. It's, I'm trying to trail the stop not too closely so that I give the profits a chance to accumulate over time without being stopped out. But at the same time, if the trade doesn't work immediately, the stop is pretty tight and it could get stopped out within 1 to 2 days.
As you look through your back tests and the history of your program kind of as it's applied, what types of environment are best for your program? Which types of environment might it struggle in?
The types of environment where it would struggle are periods, in my opinion, where the volatility is really low. And I'm basing this off the back test because I don't have enough. A year and a half with real trading isn't enough of a sample size for me to give you a good indication. But over the back test, there were 2 or 3 losing years, and they were all, and I say losing years net of that 0 and 30 and the commissions that I built in, as well as the slippage. And the 2 or 3, two of the 3 that stick out to me that I remember are 2005 and 2017. And I really remember 2017 because that was an incredibly low volatility year. So I went back and redid the back test when the VIX was below 13. And it really underperformed. It still made money, but it underperformed the average return, at the average annualized return when the VIX was below 13. So I would say, to answer your question, a low volatility environment is where it will underperform.
Well, and in 2023, you came into the year with relatively kind of normal VIX that declined for most of the year.
That's
So
right.
you've kind of traded, even in less than a 2-year track record, you have a full year of declining volatility where you were trading. And that year seems to kind of fit that thesis a little bit, with a 3.5% return with a 2.2% drawdown. So the returns weren't particularly high, but the risk was managed seemingly very tightly.
Yeah, and there's one, and maybe you want to get to this later, but there's one change that I've made from the back test since I started trading with real money. And I don't know if you want me to talk about that now or.
Please do. Yep.
It's the only change that I've made. The rules have all remained the same, but the original back test I designed with the systematic approach as a stop and reverse system, so that it's always in the market. It's either short or long, and you're just always in the market. When you get a short signal, you get out of your long and you re-enter a short, and vice versa. What I experienced in 2023 was the risk, especially as you pointed out, with a declining volatility type market, was a lot higher than I could stomach. And I tried something, and I literally spent 2 or 3 months back testing by hand, redoing the back test by hand, adding one filter. And that's all I added. But it was basically a long-term filter, and let's just call it a 6-month filter, where the trend is measured over a 6-month period, to simplify. It's not quite simple as that, but just to keep it simple. So now I've got the signals based on a shorter time frame that are triggering the execution, but I wanted to see what that longer time frame trend, using my rules again, the same rules, would indicate for each market. So let's just take the S&P, for example. If the S&P was in a long-term uptrend, I would only then take, and these long-term trends can sometimes last 2 or 3 years, not 5 or 6 weeks like this, the actual. If it was in a long trend, I would only take my signals that were long. I would ignore the short signals. And what I found, and this is on the back test, so again, it's hypothetical, but it was over 20 years, is that if you call a 0.5% my maximum loss, if you call that R, 1R, what I found over my back test, the initial back test over the 12,500 trades, the expected return per trade was 0.1R. And that doesn't include commissions or slippage, but that's just for illustrative purposes. And then if I add this filter, the 6-month filter, we'll call it, and eliminate half the trades that are counter trend, the expected return increased to 0.15R. So it went up from 0.1R to 0.15R, which is significant. And it eliminated half the trades, which will mean you'll have half the slippage and half the commission costs, et cetera. And I said, this is a huge improvement. And what it really did is it reduced the drawdowns, which is what I was hoping that I would see. And so I initiated that change on November 1st of 2023. And that's a pretty major change, but it's not a change in the rules. It's just adding one filter that I never had before. So now it's not a stop and reverse system anymore.
Well, and I think you and I talked about a couple different parts of your strategy. And I think you said one of your goals was to keep it simple. And I think that when we look at back tests that look too good to be true, oftentimes they're curve fitted.
Yep.
You can kind of keep adding and adding, but yours from our conversations is pretty straightforward.
Yeah, like I said, no rules changed, and even on the long-term filter, I'm using the same rules as I do on the short term. It's just I'm using it on a much longer time frame, a time frame that's 20 times as long as my actual, roughly 20 times as long as my actual signals.
Right. Well, so as people look at programs, and obviously you've been in the industry for a long time, kind of what do you think makes your program unique, and what are the principles in it that you think will make it sustainable going forward? Obviously, markets change all the time. We have more and more government involvement and Fed influence and things like that. Kind of, what makes your program a good fit going forward?
I think it's unique because, I mean, I listen to a lot of podcasts. I have listened to a lot of podcasts over the last few years because this is something new for me. I was always a discretionary day trader, and this is systematic position trader. And the ones that I really, and I think it's just because they're so available. I listen to a lot of Jerry Parker podcasts, and I think if he looked at my program, he would say that's short term. He's much longer term. But I would argue that if I have an edge and I can make, say, 17 trades per year per market with this approach, and the average trade makes 0.15 R per trade, why wouldn't this be better? I mean, I'm sure there's slippage and commission costs and everything, but still you have a pretty good edge on every trade. Whereas with his style of trading, I think would be more geared toward what my filter looks like, where he might make one trade. And there are other trend following firms, obviously, that do the same thing. But from what I've seen, they're all longer term. This is a little bit shorter term, but with this new change, it still has the long term as a filter. So I think it's unique. I haven't seen anybody, and I'm sure it exists, a program like this exists, but I haven't seen anybody combine the two time frames like this, and I think that's unique. And I think it will stand the test of time because it uses the three principles that we discussed at the beginning. And it controls the risk through the tight stop. It has a trailing stop. It allows the profits to run so that you get these outlier moves because of, a fear of missing out, let's say, in a particular market, or the fear of losing money. And so these moves get exaggerated in these futures markets. And it's hard to predict when they'll happen or which markets will get impacted the most, but they happen. And I think that's why it'll survive the test of time.
How would you know that it wasn't working? Kind of what are the ranges where you'd be surprised to the upside and the downside, and when as an investor might you get concerned that it's not performing as expected?
Well, I think the first clue would be that the volatility gets really low again. And not like we had in 2023, because it can still work in an environment like that. But if it persisted for 10 years, it probably wouldn't be the best place to be, in terms of, there'd probably be other assets that would outperform this program in an environment like that lasted that long. I don't think that will happen, but if it does, then that would be a warning sign for me. In terms of actual performance, in the back test, I haven't seen, the worst year I saw was like I said, 2% drawdown, or 2% losing year, net. If I saw more than 1 or 2 years that lost more than 1 or 2% in a row, consecutive years like that, that would also be a red flag, because that didn't happen in the back test. Especially now that I made what I think is a major improvement to the back test by adding this filter. So, I mean, could it have a losing year? Of course. But multiple losing years, that would be, especially if it's more than 2%, that would be a warning sign to me.
What kind of monthly volatility would you expect kind of in a down period? Does the system typically just slow down the trading? Would trading, in a 2017 year, would trading just be very limited with a bunch of small losing trades? Would it kind of be a mix of up and down trades? Would a bad month be 2 months, 2%, 3%?
No, in 2017, and this is when with the stop and reverse, the volatility from month to month, even though it was down 2%, I'd have to go back and look, but that might have been the year where it had a 20% drawdown. I mean, I would suspect that those 20% drawdowns are coming in those years that are flat to down 2%. So typically the flat years will have the higher volatility. But now, having said that, I'm more on, since I've started this, I'm more on pace with the dial down risk at like a 6.6% annualized return with a max peak to valley drawdown of 2.3%. So, and I'm starting to ramp that up, ramp up the position sizing, because I've seen enough evidence since November when I made this change that it's going to work. But during the back test, there were the years where the performance was not very good. That's where you're going to have the highest drawdowns.
Okay. And then just looking at the back test, obviously higher volatility would then be the opposite side of that. What would kind of be the upper end of a year as far as performance that you might expect?
Well, during the back test, there were some 45, 50% up years.
Right. Like to 2008 type.
Yeah. And that's typically when a year like 2008 is typically when it will work the best. The high volatility years, because you get multiple sectors making large moves in both directions. And you almost don't have losing months in those years. I mean, you might have 1 or 2 losing months in a year like that. So in those good years, I mean, I think what I've learned is, as the volatility is increasing, it's okay to ramp up that position size as close to 0.5% as you want to get, because those are typically the best environments for this program.
And the discretion you're exercising now is really on position sizing or omitting a trade, right?
Right. That's it. I mean, nothing else.
So as you got larger, I think you and I discussed one of the only changes you might make would be to fully systematize it so that the system was doing all of that. But obviously, you've been trading a long time, so and doing it discretionarily. So just kind of having a pulse on the market is something you've been paying attention to for a long time.
Yes, and I especially with something new like this for me, I wanted to see real time over a year or two at least how this performs, watching it perform on a day-to-day basis. It's not that all the orders can be entered ahead of time, the stop orders, and as well as the entry orders, so that I don't really have to be sitting here watching the screen all day long. I know exactly where the next long trade or short trade or stop will take place for each of the markets. But the goal over the next 6 months or so is to fully automate the execution, which will make it a little easier for me. And I want to do that now because I'm pretty confident that I'm not going to make any more significant changes. I'm happy with the rules as they stand now.
Okay. Well, and the current assets are over 10 million.
Yes.
Is that mostly friends and family money? People you've worked with before?
It's people. It's actually one other person I worked with before, and one other investor, both investors that I've worked with before, and I'm just at the point now. I haven't really even tried to raise capital yet. I'm just at the point now, so this is good timing for this interview, where I want to ramp up to the next level and raise as much money as I can. Like I said, I think 200 million is where I would want to take another look at how much more scalable the strategy can be. But at this point, there are no concerns about how scalable it can be. I'm pretty confident that I can get up to 200 million without any problems with liquidity.
Okay. Very nice. Well, out of respect for your time and kind of making sure that that we keep this pretty focused on your program. Minimum investment size right now is 500,000.
That's right, and that's because I might be holding as many as 10 positions overnight, and I want to keep that margin, that max margin, at 20%. So yes, the answer is yes.
Right. And for people who invest early, obviously it's pretty early on in the program, so you're not charging a management fee. So performance fee only at 30%.
Correct.
And maintaining a sharp over one so far, which is where you want to be at this point. And obviously as you go on, maintaining that can be difficult, but your program looks pretty steady. Where are you trading now?
Trading out of an office in Lake Forest.
I mean, which FCM are you trading out of?
RJ O'Brien. Sorry.
RJ O'Brien. Okay. So you can give up to any of the other FCMs.
Yes.
So you're ready to go there.
Yes.
Very nice. All right, Greg. Well, it's nice to get two Gregs on a call to talk about new programs here. And we're excited to have you on our site and see where this goes.
Okay. Thank you very much, Greg. Appreciate it.
All right. You're welcome, Greg.
All right. Take care.
All right. You too.